Hey class, this is Ethan, and this is my stock valuation project. I'm digging deep into Medtronic on Morningstar, MDT, the go-to company for pacemakers, insulin pumps, and medical robotics. They currently have a revenue of $33.5 billion and a current price of $93.22. I'm calling it a decisive sell. They're headquartered in Ireland since 1949, and MDT statistics tell a 5-year short story, flat from $110 in 2020 to $93 today, underperforming the S&P 500 by 80%. It's stable, but there's zero growth. The news on MDT is mixed. Sure, FDA just gave Altaviva the green light, and Hugo's robot is queued for 2026, which are both major innovations. But the quarter 3 revenue is missed. The stock dropped 4.5%. Healthcare inflation sits at 5.2%. Recession fears delay elective procedures, which is about 30% of revenue. And of course, the China tariffs challenge approximately 15% of sales. So the net momentum is negative. The price to earnings ratio of 16.75 looks cheap next to the industry average of 22.5. But when you factor in how slowly Medtronic is growing at just 4.1% a year, that 16.75 starts to look a little high, especially when you begin to compare it to its competitors such as Abbott and Boston Scientific that are growing at 5.2% and 12% respectively. They're growing faster, so investors are fine paying more. Medtronic's return on equity of 4.7% is decent, but it hasn't budged in years. And over the last 5 years, sales have stayed flat, with the P/E itself has shrunk, meaning the stock used to be even more expensive for the same slow growth, which is underwhelming. Morningstar rates it a 3 out of 5 stars with a $124 fair value, but the current price is 62% above what the cash flow supports. The 5-star buy zone starts at $89.50, and the price is already $4 above that with no room for error. Bulls point to AI and diabetes, bears point to delays and antitrust issues, but the recommendation is to sell. The PE calculation uses $5.57 in earnings per share from the last year. Adds 5% growth. The company guides 4.75, reaches 5.85 for the next year, and applies a 15% multiple that is reasonable for a mature medical technology company. This gives 87.75 before adjusting for risk down to 82.50. The stock is 13% overvalued at the current price. The math is simple. 5.85 times 15, 87.75, adjusted to 82.50, which is about a 12 to 15% decline, potentially. But some key points of this are 3.0% dividend yield, 54% payout ratio, medium ESG risk from supply chain emissions, 83% owned by institutions with insider selling, debt to equity of 0.52, and strong cash flow. Solid company, but the stock price is not at all attractive. So my recommendation is to absolutely sell. Take the profits while you can, move it into a more forward, innovating, and more higher growth company like Abbott or Boston Scientific, because even as reliable and steady, it's not challenging, but it's also not beneficial. Even if it's a reliable dividend payer with good technology, it's not a good buy when the growth is low and the economic conditions are challenging. So thank you for watching. Any questions, just shoot below. My last resort is to just stop sharing and to sell your MDT. Thank you.